Hello everyone, my name is Vikas Shukla, and in today's video I'm going to answer a question that has been asked, and that is about a covered call versus buy hold strategy in the stock market. So if probably because you are looking at this video, you already know what is a covered call strategy. I will not go into the detail of it. The basically you already have a stock, and then that's different from, because it's covered call. I will not talk about the naked call, because probably you don't have that account that allows you to do a naked call. But the covered call means you already have a stock, and then you collect a premium if that stock does not hit a strike price. So I will explain it with a quick example. Let's say Amazon, it's a stock share. It's currently 3,200, for example, and then today is August 7th. So what you do is you set a call sell for, let's say, August 21st, and maybe you look at the strike price of, for example, 3,400. So what you are doing is maybe you collect maybe $50 of this premium if you buy a covered call, and then if the stock price hits $3,400 or above, your stock gets sold. If it does not cross hits the strike price of $3,400, you collect a $50 or so. Don't quote these prices. Go and check the financial.yahoo.com or any other website for the current this price of that premium and the price, the date. Basically, there's all three variables. You need to look at the strike date, the strike price, and look at the premium what it is offering. So that's how the expectation is for this covered call strategy is this. You expect that the stock will move very slowly. So here is how I'm expecting that this is my time, and then my strike price, let's say 3,200 now currently. So you expect the stock to move very slow, in a slow fashion, or if it goes down and moves, that's also okay. And but that the rise should not be very steep. So here on these 2 weeks, for example, between August 8 and August 21st, you collect the premium of $50. Next 2 weeks, you again collect this premium of $50. You keep collecting all those premiums of $50 of every bi-weekly or so. What a period of time these premiums add up. You still keep the share. The problem happens is like this, something like this. On one of the weeks, your stock, instead of 30, it's right here, you are 3,200, and it steeply goes up, and then it keeps moving up. It hits 3,500 here, and then you do make some money. You make the difference of this $200 here, and plus you make this premium of 50 or $250. So that's good. That's a good part of it. The bad part of it is that if your stock keeps going up and hits the 4,000, then you don't get this whole gain. That you lose it, and that's where the second strategy, the buy hold strategy, works better. If the stock happens to rise very steeply in a short period of time, so you miss the train, in that case you underperform compared to the covered call, compared to the buy and hold. So I put the stock that you hold in two categories. Number one category, let us say the stock has been more or less fully valued, or it's a little bit, you think it's an overvalued. You are holding the stock for a long time, but now the stock market has gone up. It has saturated in terms. It's fully grown up to the point you think it's saturated. The further room of the growth room is very little, or if there is a growth at all, it will be slowed down. It will be a slow growth. Once the stocks reach to a certain saturation point, they grow slow. The number two category of the stock, they are typically like a startup company. The stock is not fully grown up, but it still has a lot of room to grow. For example, it could be Tesla. It has grown up quite a bit, but still has a room to go. It could be something like Nikola share, maybe Neo, another electric vehicle share, has a lot of room to go. It just started, and there's many years of the growth that's left into them. So in that case, it's probably better to not do a covered call, because suddenly a good news comes and then your stock gets sold. You get a little bit of profit, but you miss the much more longer growth that has yet to come. On the other hand, if your stock has been fully valued, for example, Amazon stock, it's currently like 1.5 trillion dollar stock already. There is very little chance. It has all the market that it could capture in United States. Every single customer has that. Not that it does not have more room to grow, but that growth will be a slow fashion. It cannot quickly go from 1.5 trillion to 3 trillion dollar in a very quick fashion, because there are not so many more. True, its cloud business will keep growing a little. It has still some more room to grow. With coronavirus, it has already captured the maximum shipment it could do, and now onwards, probably its consumer sale business will grow. We will actually go down right after the coronavirus, because people will start buying again to the grocery shop as well in place of Amazon. Its cloud business will probably keep going, but it won't go that fast from 1.5 trillion. To expect that it's going to be quick from 1.5 trillion dollar to 3 trillion dollar is very less. And therefore, if I own a stock like Amazon, I would prefer it a covered call strategy, where the stock has been more or less fully valued. Slightly overvalued is even better. I won't say Amazon is much more overvalued, but it's still, my personal feeling is slightly overvalued for certainty. So it's a good candidate for covered call sell. On the other hand, if we have a stock which is like a Neo car, it just started out. It has still a lot of room to grow, and it will keep increasing for many years it will keep increasing for many more years to come. So in that case, covered call strategy probably is not the great strategy. You probably just do, or if you do a covered call in the case of Neo, try to set a strike price which is much higher than the current strike price. So even if you sell the stock, you are selling it at a much higher price. So that is my understanding. In overall, I would not do a flat comment on covered call or a buy hold. It depends upon different individual stocks. But in general, if the stocks are valued, and if for example, the current market, which is market has already peaked up. For example, the S&P is at close to 3,300. The market is close to peak. I believe that most of the stocks they have been valued. So if you are still owning a stock, it's probably a good idea to start covered call, except for the stocks that are like a new stock, that are like a startup stock. Other than that, at this point of time, I would do a covered call for all the established stocks. For example, Amazon, maybe Walmart, all other stocks that are going good. I would like to draw a graph that's showing how a typical covered call versus buy and hold strategy works. So let's say if currently the stock looks like this around the March 20. This is the time of at this point we are at March 23 low, and the stock starts rising up. So probably if you got some stocks here right now, then if you do a covered call, you probably lose, because the stock this rise was very steep like this, and you lose your share somewhere here, but the stock keeps rising, so you do not capture this stock. If you got some share at a relatively low price, it's probably better to hold. I mean, your stock actually will grow like this, so you will have this much of loss. So depending upon where you are, but now if you try a covered call at this point of time, right now here when the market is probably fully valued, the market is expected to grow like this from here onward, or maybe like this here. There's a very little chance it's going to go up this, but at this particular point of time, if you do a covered call, that will be a right strategy to do for the covered call. At the same time, let's say if the market goes down steeply right here, and you pick up a stock somewhere here, which will be at like any level less than 2800, and so, and if you get a stock here, probably at that particular point of time, it's better to hold it and wait for it to come up a little bit, and then do a covered call sell. So I hope I have given a very broad overview of what you could expect the covered call versus buy hold, depending upon how the market currently is. At present, I will say that the market is fully valued or slightly overvalued. Not that it cannot go up. I'm not a astrologer, or I do not say with conviction that it will not go to like S&P index of 4,000. But I see that chances of that happening is less, and the chances are more that it will stay at this point, or grow very slowly, or go down, rather than going a very quick steep up to a 4,000 index level. So I hope this thing is helpful. If you want more questions like this, you can ask me and I in the comment section. And if you can subscribe, you will keep getting more videos like me from me like this. Thanks for taking a look.